So what's the best type of life insurance to have? Okay, so let's break this down into categories. So most people are going to have some type of policy through their job, right? That's called group insurance. So with group insurance, one thing you have to know is the company that you work for, they actually own the policy. So you don't own the policy, they own it. The good thing is that in most cases, you don't have to qualify for it. So it's part of the benefit package. It makes it more attractive to, keep and retain employees. So long as you work there, you'll get the coverage. Okay. So now, one thing you have to look at is that it is cheaper, but a lot of times they use a lot of different subcategories to inflate the numbers, meaning you may have, 50,000 as a base or 20,000 as a base, but then you have an additional $900,000 in accidental coverage, right? It looks great on paper, but what you have to understand is that if you have accidental coverage policy, and let's say you didn't die, you got in an accident and you got transported to the hospital and then you died at the hospital, there's a chance that policy will not have to pay out. Meaning you didn't technically die from the accident. You had a seizure or something else at the hospital. So it becomes a game of technicalities. So you want policies that are either I'm alive or I'm not. Pure insurance. Either I'm dead or I'm not. How I got there doesn't matter. I need this to pay out to my family. Or even sometimes they add cancer insurance. With cancer insurance, the way that works is, let's say you received cancer, you got cancer, received cancer, you got cancer, and you have this policy and now you're not working. Unfortunately, a lot of benefit packages rely on you to work a certain amount of hours. So you're out of work because you have cancer, but then your hours decrease. So now your benefit package goes away until you work the requirement, hours for that quarter or for that year. So now you don't even have coverage anymore. You don't have benefits anymore because you're out because you have cancer. So it defeats the purpose of having the cancer policy. And these are things I've just seen over, I've been doing this for almost 2 decades. So these are things that I've seen over the years where I'm like, man, insurance can be a shady industry. So you want to make sure somebody has your back that knows what they're doing so they can explain it to you. So group insurance, I would say keep it. I mean, I'm not saying it's bad, but you have to be aware of what you're paying for. It's going to be extremely cheap, but just know how much of that is base insurance where it's either I'm dead or alive, not circumstances how I die. So that's your group insurance. Then we have term. So term is going to last 10 years, 20 years, 30 years, sometimes 35 years, and then it's over. So it's temporary coverage. Now, because it's temporary coverage, it's going to be a lot cheaper, let's just say on a monthly or annual basis. And here's why. There's a high chance, somewhere around 95 to 98%, depending on the study you look at, of a chance that you would outlive that policy. Meaning if I got a 30-year term policy, there's a 98% chance that I will outlive that policy, which is good because you're alive. But from a financial perspective, you paid into that policy during that period of time and you receive no benefit because you didn't die on time, right? You don't want to die on time. You want to outlive the policy, but you have to understand the longer you live, the worse the situation is for you. So that's term. The good thing is that it is cheaper, right? So you can get more bang for your buck. Situations where term works really well is, let's say you have minor children, because a lot of people think like, oh, well, I don't want to pay into this for 30 years and they get nothing out of it. But let's say you have a minor children. Let's say your children are 4 and 5 and you get this $1 million term policy for 30 years. When 30 years is up, that those children are now 34 and 35 years old. So they're a lot more financially independent, we hope, than when they were 4 or 5. So the insurance actually did its job during that period of time because the job was to keep the pillow softer at night, knowing that if something happens to you, your kids will be taken care of during that period of time. But once they become adults, they need to start taking on some responsibilities. So that's where term can work well if you have minor children or you have a family you want to make sure you leave something behind for. And then you have mortgages. So let's say you have a 30-year mortgage. Your loan is $300,000 for 30 years. You get a 30-year term policy. Yes, your term policy will terminate in 30 years, but also what happens in 30 years? Your mortgage should be paid off. So it did its job, right? So those are situations where term works well, where you're replacing your income for minor children, or you're trying to cover a mortgage, right? So that's term, most bang for your buck. Then we move on to permanent. So permanent is going to be a policy that lasts to around age 120. That's what they consider permanent. Now, in that situation, the premium, which just means payments, are going to be higher. And the reason it's going to be higher is because the insurance companies understand it's very unlikely that you will outlive 120 years old. So they are on the hook for that death benefit. Whereas term, they're just taking all those premiums and they're like, it's very small chance we'll have to pay out anything because they're going to live too long. So that's a lot of profit, right? But with permanent, they're still taking those premiums in, but they know like one day they're going to have to cut a check for, $100,000, $500,000, $1 million, or whatever amount of coverage you have. So the premium is going to be higher. It's a higher charge. Also within it, all of that premium doesn't pay for the insurance. Some of that premium some of that premium goes towards cash value. So you have a component where you can build up, equity in a policy and things like that you can leverage for, you want to buy something, buy a home, or some people usually like to be their own bank, whatever you want to use, tax-free retirement, all these different strategies you can use within the policy, utilizing that cash value. So that's permanent. And different permanents are going to be whole life, universal life, variable universal life, and index universal life. Those are going to be your permanent policies. So age 120 versus 10 years, 20 years, 30 years, 35 years in some cases. Those are going to be your options. One's going to be more expensive, but it's going to last longer. Now, what you want to look at is how much insurance do you need? So one of the most strategic ways to figure out how much insurance you need to determine which policy is best for you is a method called DIME. So DIME like the coin, like the money, DIME. So D stands for your debt. You want to look at how much debt do you have, right? And write that down. I stands for your income. You want to take your income and multiply it times 10, or if you want to be really aggressive, times 20. So let's just use times 10. So you have your debt and your income times 10. M stands for mortgage. So you take how much do you owe in mortgages, you put that down as well. And then E stands for education. So how much do you have in education expenses, future education expenses for children and things like that. So that's the DIME method. So when you add that up, there's a dollar amount. And let's say that amount is $2 million. That shows you need to get $2 million of coverage to fulfill the DIME method. Now, financially, the most bang for your buck is going to be the most affordable to get a term policy. Because again, you're going to have, the cheapest amount of, the cheapest payment for the most amount of coverage with a term policy. So that's where you use the DIME method. So in some strategies, it is a blend. Let's say you have a goal, because your goals matter. So if your goal is to, help with a mortgage, or your goal is to take care of your minor children, probably look at term. If your goal is, hey, I want to make sure I guarantee I leave something behind for my kids because nothing was left behind for me. I want to start building generational wealth, or I want to, create like a family bank, or I want to utilize this cash value, then it's going to be permanent. Or I want to make sure I cover estate planning, that's going to be permanent. So those can't be done with term. So, it's not like a one size fits all. So maybe there's a blend. Maybe it's okay, I need $2 million, so let me get $1.9 million in term to make sure my family's taken care of, my obligations are taken care of, and let me get $100,000 in permanent because I want to make sure something's in force when I pass away at age 111, right? So for me personally, I have several term policies. I have several permanent policies. Each policy has its own goal. Each policy has its own objective. So based on your situation, you have to look at, what's important, what the actual goals are for you. So another thing you do have to look at is what's affordable as well, because you can't just get a $2 million policy if you can't afford it, because you still have to make sure you're taking care of your financial obligations and you are saving money. So that's where term can come in. If you can only afford, $30 a month and you have a family, you have kids, it may be only term for now, right? And then you build up and you want to add something permanent later. So you have to make sure you're within your budget. You can't say, hey, I have $1,000 discretionary, meaning after all my bills are left over, I have $1,000. I'm gonna put that $1,000 towards your insurance. Absolutely not. A portion of that you can put towards your insurance, but you need to be saving for short-term, mid-term, and long-term planning, right? So that's important. You can't ignore savings for insurance. Sometimes with some policies, it kind of gives you a 2-for-1. I still recommend saving outside of a life insurance policy, whether it has cash value or not. And then the last thing I would say is health conditions, right? So let's say you have a health condition where you can't get insurance, you can't qualify. You probably want to look at some type of guaranteed coverage or guaranteed issue. those are whole life policies where they don't look at your medical background. They have no medical questions. Just as long as you're competent and can sign the form, you will get guaranteed coverage. Usually you have to be around at least 45 years old to get these policies, but that is a whole life policy. And for a lot of cases where someone has those issues, that's going to be the way you want to go, right? Because no matter what, you want to make sure you stay away from having to do GoFundMes and, fish fries and things like that. So, and I don't assume that anyone that's watching this is at a certain, statute wealth-wise. Some people may be $30 a month, but I have clients that put $1 million inside of life insurance policies. So whatever scale you're on, these principles can apply to you. Other than that, if you have any comments or questions, drop them in the comments section. If you receive any value, always put a happy face, so YouTube knows this is a decent video. And of course, subscribe to the channel, and I will see you in the next video.